You log into your brokerage account, and there it is, a glaring minus 30% next to a stock you own. The immediate behavioral itch is to average down. You want to buy more shares at this new, lower price to drag your average cost down to a number that feels slightly less painful. Averaging down is often treated like a test of courage, a way to prove you have conviction when the market panics. But it is purely a mathematical decision. Do it wrong, and you end up catching a falling knife with your rent money. Investors look at a massive percentage drop and convince themselves a stock is simply too cheap to ignore. But percent from high is an illusion. It tells you nothing about the true valuation of the company today. We already covered the 3 pre-purchase PE checks in Stock Math number 1. This is the sequel. This is the exact protocol you must run after a stock in your portfolio crashes. Surviving a red portfolio means turning off the emotional urge to buy the dip and putting every falling ticker through a rigid 3-part mathematical filter. This chart shows a typical scenario. Rahul bought a stock at 200 rupees. Now it's 120, and he wants to average down to 160. Before buying, he must clear check 1. He verifies his original reason for owning the stock, like high earnings quality. If Rahul originally bought in because a friend told him it would double, he doesn't have a thesis, he has a rumor. The checklist fails right here, and he must stop immediately. To pass, he needs an actual thesis, and he has to verify it against live data. That means checking the latest quarterly results, verifying current debt levels, and looking out for any spikes in promoter pledges. Throwing new money at a dead story, like a recently exposed fraud or a total earnings collapse, just because the percentage drop looks large, is a guaranteed way to burn cash. Averaging down is only up for debate if the underlying business reality remains exactly as good as it was before the price dropped. If the stock passes check 1, we stop looking at the asset and start looking at your wallet. This brings us to check 2, dry powder versus emergency. This bar chart represents your total cash. The large, locked section is your emergency fund, meant strictly for rent and living expenses. If Rahul pulls from his locked 80,000 rupee emergency fund just to find 30,000 to average down, he fails this check entirely. This rules out the impulsive habit of taking your salary and dumping it into the market just because the chart happens to be red today. Buying a falling stock with money required for near-term survival concentrates your personal financial stress. Finally, we look back at the asset for check 3, cheaper versus broken. We have to determine if the price is down for a structural reason. This dual line graph shows a genuinely cheaper stock. The price line drops, but the business's actual earnings remain completely flat and steady. But watch what happens with a genuinely broken stock. Both the price line and the earnings line drop simultaneously, running parallel straight down. When cash flows and balance sheet health deteriorate right alongside the stock price, that lower price is not a discount. It is an urgent warning to stay away. Separating a temporary market discount from a dying business is the only mathematical way to avoid catching a falling knife. This 3-step protocol destroys a lot of retail myths. Yes, averaging down lowers your cost basis, but it also dangerously concentrates your overall risk in a single name. People assume that if a stock already fell 30%, it somehow can't fall more. Equities have no floor. They can and do go to zero. A systematic investment plan in a single falling stock automates your mistakes. You can use AI or spreadsheets to pull the last 5 years of financial data, cash flows, and debt ratios. But the final decision to allocate capital cannot be outsourced to a machine. Before you add a single rupee to a falling stock today, sit down and physically write out your original thesis. And if you want a pocket-sized version of this exact checklist, check out the short video linked below.